Hello and welcome back to Module 1 of the Stock Market Masterclass, Fundamental Analysis. In the final section of the Fundamental Analysis series, we will look at top-down and bottom-up analysis, analytical methods used by financial analysts around the world to help identify the best investment opportunities. In this section, you will learn the top-down analysis approach and how to apply it. We will learn how the top-down analysis works using a case study. We will learn the bottom-up analysis approach and how to apply it. And finally, we'll learn how the bottom-up analysis works using a case study. Many investors start an analysis process by looking at individual companies they are interested in and make decisions based only on current share prices and what they perceive as value. Top-down and bottom-up analysis methods provide analysts and investors far more information to base investment decisions on, and the method that works best for each investor is generally dependent on their investment goals and experience. Let's first look at top-down analysis. Investing using a top-down analysis approach focuses on the bigger picture, also referred to as the widest lens, to help understand the state of the economy and different market sectors as part of the share selection process. Far more emphasis is placed on the state of the economy and the market trends than on the individual shares, which generally makes the turnover of investments more frequent. This process is generally carried out in three stages: economic analysis, sector analysis, and individual company analysis. You will remember that each of these stages were covered in detail throughout the previous sections of this module, and top-down analysis brings them all together to help an investor make the most informed decisions based on information derived from all three stages. Top-down analysis is often viewed as a strategic approach to investing, which generally benefits passive investors with long-term views on the market performance and expectations. Let's first look at global and domestic economic analysis. The first stage involves investors looking at microeconomics, a division of economics that focuses on large-scale data like global and country-specific GDP, federal funds rates, and inflation rates to assess the state of the broader economy. From this information, an investor is trying to identify where the broader global economy is placed in the economic cycle, in an attempt to choose the sectors that will outperform in the current climate. Once the global economy's position in the cycle is established, an investor can filter down the focus on the state of the domestic economy. Understanding the domestic economy position relative to the global economy is an important part of the analysis process and includes research in the key areas of GDP, interest rates, inflation rates, and unemployment rates, to name a few. The importance of domestic comparison was highlighted throughout the global financial crisis, the GFC, where unlike most of the world's major economies, Australia didn't slip into an official recession in terms of a GDP number. To highlight this example further, this information throughout the early stages of the GFC may have given an investor valuable information about the material sector, Australia's lifeblood at that time, and how it remained high for nearly 9 months from the start of the GFC while the global markets were in freefall. The chart that we can see on the screen displays the material sector compared to the S&P 500 index during the 9-month period post the GFC market peak. Then we move on to sector-specific analysis. Stage 2 involves analysing the 11 GICS market sectors and their performance relative to the current market positioning on the economic cycle. Now that an investor understands where the current market is on the economic cycle, the next process is identifying the sectors which are expected to outperform during this period. Now, there are generally multiple sectors that are expected to outperform at different stages of the economic cycle, and an investor can identify and compare sectors with similar expectations with the view to identify the best investment opportunities. Sector-specific analysis is carried out by using some of the fundamental metrics explained earlier in stage 1 with the addition of technical analysis to help identify potential trends and/or weaknesses between comparable sectors. The final stage is company-specific analysis. This stage of the top-down analysis approach is identifying opportunities in specific companies. An investor now understands which sectors are expected to perform well in the current climate and can narrow the search for individual shares that belong to these sectors. As you can see in the example on the screen, company-specific analysis is carried out by using the fundamental metrics explained in the previous section, including PE ratios, PB ratios, PS ratios, and DE ratios. Comparing like-for-like companies in the same sector can give an investor a good understanding of how the company outlook fares against its peers, thus providing an opportunity to identify potential value that may otherwise not be as apparent. By following the top-down analysis process, an investor has the benefit of selecting shares that belong to sectors that are expected to outperform the broader market and put themselves at a distinct advantage as they're investing in line with the ebb and flow of the economic cycle. Let's now take a look at a top-down analysis case study. In order to demonstrate what a top-down analysis approach would look like in reality, let's now apply the process to a case study. For the purpose of this study, we'll assume that our investor, Bill, is looking to construct a new portfolio with an investment window of 5 to 7 years. Bill is not concerned with the diversification for this portfolio, as it only makes up a small portion of his financial investments, but he seeks to capture the best growth opportunities for the next 7 years. So Bill first looks at the global outlook by researching the GDP, inflation rate, federal funds rate, and the major economies' unemployment numbers. Bill found that the global GDP levels have been falling for 4 of the last 6 quarters, with the most recent quarters remaining flat. Unemployment rates are on the rise in the US, Asia, and right through the major centres in Europe, and although inflation rates have remained steady for the last 2 quarters, the federal funds rate has fallen to a record low, with a future rate cut forecast in the next quarter. The Australian economy has mirrored that of the larger world economies, with interest rates at record lows. Australia's GDP has also fallen in line with the global decline for 5 of the last 6 quarters, with the exception of the most recent, which was unchanged, and the inflation rate has flatlined. Although the Australian economy looks weak, Bill noticed that there has recently been a small drop in the domestic unemployment rate. Bill also found that new housing starts figures have increased for the last 2 months, and consumer spending figures have increased slightly from the previous month. Bill's initial thoughts are that the market is either in a contraction or trough phase of the economic cycle. Now he moves on to the sector-specific analysis. Bill has now shifted his focus to the domestic market sectors, where he identified some interesting information that backs up his thoughts about where the market currently stands on the economic cycle. Upon comparing the recent performance of domestic market sectors, Bill found that utilities have been generally outperforming other sectors for the past year, with financial sectors being the most notable below-average performer. Bill found that the financials and utility sectors have the biggest deviation in performance and decided to overlay the two sectors on a chart which displayed the last 18 months. Bill discovered that the utility sector's upward trajectory has recently been slowing, and the financial sector has stopped moving lower and has started to move up at around the same time. Bill then overlaid both sectors with a chart of the ASX 200 for the same period, which also confirmed that the speed of the move down on the ASX 200 had significantly slowed and most recently had started to move sideways. Armed with his research from stage 1 and stage 2, Bill has identified the world's economy has been in contraction, but there are signs that the domestic market could now be in a trough phase. Now he moves on to company-specific analysis. Using this research, Bill can now focus on the sectors that traditionally outperform the broader market in the trough phase of the economic cycle. Bill has identified the financials and consumer discretionary sectors as the ones most likely to outperform the broader market in a trough phase, and has chosen to focus only on companies that fall into these categories. Bill only wants to invest in Australia's largest companies, so he has narrowed his search to only companies that are in the top 20 by market cap. Bill first researches the data related to the important fundamental metrics and compares the companies in the same sector to each other and to the sector itself for potential clues as to which company may be undervalued. Bill decides after reviewing the data that ANZ is the company that seems to be undervalued for the following reasons. ANZ has a lower PE ratio than the other major banks. A low PE ratio indicates that the share price has fallen, while company earnings may have remained relatively unchanged. As we have already learned, share prices can fall for a variety of reasons that don't directly relate to the individual company, and thus, in these circumstances, the company could maintain steady earnings. ANZ has a lower PB ratio than the other major banks. A lower PB ratio suggests that it may be undervalued, as ANZ's market price is trading closer to its asset value than the other banks. This could act as a safety net if the broader market decreases in value, as the other banks may fall quicker and further in price. ANZ also has a lower PS ratio than the other major banks, which indicates that investors are willing to pay less per dollar of sales per share than for its competitors, suggesting that the company may be undervalued. High PS ratios often indicate that the company is overvalued. ANZ has the smallest DE ratio of the major banks, which indicates that it may have more borrowing capacity in the future. This also suggests that it can withstand further weakness in the broader market, making it a less risky proposition. Bill decides that he will buy ANZ to represent the financial sector, and he also decides that he wants representation in the consumer discretionary sector, so he also purchases Wesfarmers, as this is the sector's only company represented in the top 20. It is important to be aware that real data was not used in this case study, and in no way recommends a share purchase, but it does highlight how important this analysis approach is. This process has given Bill a good chance of success, as he is potentially buying a sector's most undervalued company. It is also important to note that this sector is also expected to outperform the broader market because it is at the right position on the economic cycle. Let's now take a look at bottom-up analysis. Bottom-up analysis is the opposite of the top-down method, where most of the emphasis is placed on the individual companies first and foremost, and is not as concerned with the economic outlook. Bottom-up strategies are extremely reliant on fundamental analysis, as most of the research is carried out on the individual companies. Investors who use the bottom-up method generally have a good understanding of the industry that the company under review belongs to, and expect that that company could perform well regardless of the state of the economy or even the sector itself. Investors often have a level of understanding of how the company being analysed operates, hence why microeconomic factors, the division of economics that studies the behaviour of individuals and companies in decision and interaction processes, are considered. As an example, an investor may want to research a company in the telecommunications sector. The investor already understands the product and services that the company supplies before they delve deeper into the management and company financials. This is an advantage for the investors because they have a reasonable expectation of how the company should perform in certain aspects of their business, as opposed to researching a company they know nothing about. Bottom-up investors generally invest for the longer term, where a buy and hold approach is employed to give the individual company the chance to fulfill an investor's expectations despite what is happening in the broader market. Once again, there are generally three stages of the analysis process with bottom-up investing, and as you have probably already guessed, are the opposite of the top-down approach. First, we look at company-specific analysis. Like the top-down approach, company-specific analysis is carried out by using the fundamental metrics explained in the previous section, including the PE ratios, PB ratios, PS ratios, and the DE ratios. Now, because far more emphasis is placed on the individual research of the company, investors look deeper into the company's organizational flow, management, and future forecasts to gain a more meaningful understanding of the company's prospects. This gives an investor an almost intimate understanding of the company's structure, which puts them at an advantage when comparing it to like-for-like companies that provide the same or similar products or services. This information is invaluable in terms of an investor making an assessment on whether the company is a good value proposition compared to its peers. Then we move on to sector-specific analysis. Stage 2 involves comparing the company financials and metrics to like-for-like companies. This process can help identify potential strengths and weaknesses in the company that may have otherwise gone unnoticed. For example, if the company being researched is a Commonwealth Bank, an investor can compare its metrics with the other major banks such as ANZ, National Australia Bank, and Westpac. Once the positives and negatives have been identified in the like-for-like companies, the next step is to compare the metrics with companies that are in the same sector but not necessarily like-for-like. As an example, if the company being researched is a miner, it would be advantageous to research companies that supply mining companies with equipment and technology to see if the forward forecasts are in line. Other industries like logistical and export companies that provide a service for mining companies can also be compared, as they can potentially offer information on how the industry as a whole is tracking. Sector-specific analysis is carried out by using some of the fundamental metrics explained earlier, with the addition of technical analysis to help identify potential trends and or weaknesses between comparable companies. We then move on to global and domestic economic analysis. The final stage involves investors looking at macroeconomics to assess the state of the broader economy. From this information, an investor is trying to identify where the broader global economy is placed in the economic cycle. Although not a lot of emphasis is placed on this data, it may give an investor more confidence that the company being researched has a favourable market trend. This may have an influence on an investor's position sizing or provide them with an opportunity to consider hedging strategies if the outlook is less optimistic. As I discussed earlier, global and domestic analysis includes research in the key areas of current and historical GDP, interest rates, inflation rates, and unemployment rates. These important metrics will provide an investor with a big picture perspective, but won't necessarily override an investment decision made earlier in the analysis process. Let's now take a look at what a bottom-up analysis approach would look like in a case study. For the purpose of this study, we will assume that our investor, Jan, is looking to add to her existing portfolio with an investment window of 10 to 12 years. Jan has no exposure to the telecommunications sector across her total investments, and has heard on the news that Telstra Corporation is currently a good buying opportunity. Now, Jan has been a Telstra customer for 10 years, and has always been happy with their service. Most recently, she noticed that the company had received some bad press, and that the share price has fallen because of it. First, Jan looks at company-specific analysis. The company-specific analysis that Jan carries out is heavily fundamentals-based, and includes PE, PB, PS, and DE ratios. Once Jan has an idea of Telstra's fundamentals, she starts to work on their organisational flow, management, and future forecasts to gain a more meaningful understanding of Telstra's growth prospects moving forward. Jan has a sound understanding of Telstra's products and services, and thinks that their new 5G rollout will be good for the company. Looking deeper into Telstra's business model and financials has given Jan more confidence about their new rollout plans, and is satisfied to move to the next stage of her analysis process. Jan now moves on to sector-specific analysis. Jan shifts her focus to other telecommunications companies in the sector to compare the main fundamental metrics of Telstra. Upon comparing the recent performance and financials of the top 3 telecommunications companies in Australia, Jan understands that on average, Telstra's financials stack up well. The key point for Jan is that Telstra is leading the charge for the 5G rollout, and she believes that their growth potential is higher because of this. Jan now compares the fundamentals of Telstra with the other companies in the telecommunications sector that are more product-specific to get a gauge on how the sector is performing as a whole. Jan identified that mobile-focused companies are faring better than fixed-line specific providers because of the release of the newer technology on a regular basis. Further, many of Telstra's competitors are preparing for the rollout of 5G, which will be a good thing for Telstra moving forward, as they control a large range of the 5G spectrum. Telstra has a healthy distribution of both products and services, and Jan is satisfied that the sector has good prospects for the future. Now Jan moves on to global and domestic economic analysis. The final stage involves Jan looking at the macroeconomics to assess the state of the broader economy. From this information, Jan is trying to identify where the broader global economy is placed in the economic cycle. Although not a lot of emphasis is placed on this data, Jan is trying to identify how much of a stake she will take in Telstra, because if market conditions are favourable, she may take a larger position. Jan first looks at the global outlook by researching the GDP, inflation rate, federal funds rate, and the major economies' unemployment numbers. Jan found that the global GDP levels have been slowly rising in line with market expectations for the last 3 quarters. Unemployment rates have been steadily falling in most of the major economies, and the inflation rates have risen in line with expectation. The federal funds rate has remained steady for the last 6 months, and a future rate increase is forecast in the next quarter. The Australian economy has moved in line with the other major world economies, and interest rates have remained steady. Australia's GDP has increased over the last 3 quarters, and the inflation rate has also started to climb. Jan also noticed that there has recently been a drop in the domestic unemployment rate, which exceeded expectations. Jan noted that consumer spending figures are on the rise, with a steady increase over the last 5 months, and the consumer confidence levels are at a 12-month high. After conducting this research, Jan has concluded that the economy is in the expansion phase. Jan decides that after reviewing all of the available information, Telstra is currently undervalued and has good growth prospects in the coming years for the following reasons. Firstly, Telstra has a long-standing history of providing their core services, of which Jan has experienced firsthand. Jan feels that the recent fall in the share price, which was related to service issues, may have been exaggerated. Secondly, Telstra's financials presented mostly on par with its main competitors, but Telstra had more scope for growth than its peers because it controls a large portion of the new 5G technology. Thirdly, telecommunications companies that solely focus on mobile phone distribution outperform the other companies who predominantly provided fixed-line services. Because Telstra has a large representation of both products and services in its business model, it is well-placed and could benefit from any future shifts. And finally, Jan concluded that the global economic outlook was good and is currently in an expansion phase. A growing economy bodes well for new technology in the communication space, as well as the need for more products and services. These factors are a positive for the entire communications sector, especially the undervalued Telstra. Once again, it is important to be aware that this case study did not use real data and in no way recommends a share purchase. This process has given Jan a good chance of success, as she is buying a long-term stake in an undervalued company which on paper has better growth prospects than its peers. The investment window is also in a great position on the economic cycle, and although this would not have influenced her decision to purchase, Jan has decided to take a larger position in Telstra because of the current market conditions. In this lesson, we've learned what a top-down analysis approach is and how to apply it. We conducted a case study using the top-down analysis approach. We learned what a bottom-up analysis approach is and how to apply it. And finally, we conducted a bottom-up analysis approach in a case study. This concludes section 4 of the Stock Market Masterclass, Fundamental Analysis. In the next module, we will look at income generation strategies and explain how traders and investors can generate extra income from a share portfolio by using a combination of long and short-term investment methods.